This is Daniela Camboni for Kitco News, and you're watching a special holiday edition of Technically Speaking with Jim Wyckoff. Stay tuned. Hi, Jim. Thanks so much for joining me for this special holiday edition.
Good to see you, Danielle, and happy holidays to you and to all of our Kitco readers and listeners.
So, Jim, looking back over the past year, what would you say were some of the primary drivers that affected the price of gold?
Well, the past year, the primary drivers were safe haven investment demand. Even though the past few weeks we've kind of seen gold act like more of a risk asset with the other commodities. If you take the year 2011 as a whole, you saw gold hit a new all-time record high of 1923.70 basis nearby COMEX futures in September, and that was driven mostly by safe haven demand due to the economic and political turmoil coming out of the European Union, and also because of some other geopolitical events such as the upheaval in the Middle East.
So, Jim, which of these factors do you think might spill over in 2012?
Well, certainly the European Union debt crisis has not gone away. It seems like almost every other day we see some kind of a hiccup or new development, and I think that's going to continue to support the gold market, mainly because you're going to see weakness in the euro currency. The other side of that is the strengthening of the U.S. dollar index has limited the upside in gold. So those two factors are going to tug at each other. But my bias is that if you see continued turmoil in the European Union, if you don't see problems get better in a hurry there, I think you're going to see resumed safe haven demand for gold, and especially at these lower price levels now.
So, Jim, with all these problems, and especially the European crisis, a lot of analysts foresaw gold hitting 2,000 by year end. Now it seems extremely unlikely, but we never know. How come this scenario didn't happen?
Well, if you've been in the marketplace as long as I have, which is pushing 30 years now, you know that the markets are going to do what the markets want to do. And analysts can prognosticate and predict, but the markets are going to do what they want to do. And gold is just experiencing a solid downside correction at present. The longer-term uptrend, the 10-year-old uptrend on the longer-term monthly chart remains in place. And if you look at that monthly chart, you can see that in past years, we've seen significant downside price corrections like we're seeing right now, and then you've seen gold gone on to set a new for-the-move high. Let me give you an example. In 2008, gold saw a $350 an ounce downside correction from its then record high, only to come back and score a new all-time high. In my mind, as a technical analyst and a student of the markets, the path of least resistance on a long-term basis remains sideways to higher because the uptrend on the longer-term monthly chart remains in place. To do significant longer-term technical damage to begin to suggest that this long-term uptrend might be coming to an end, you're going to have to push nearby COMEX gold futures prices significantly below major psychological support at $1,500.
So, Jim, headed into 2012, what are your expectations?
If you look at the longer-term monthly chart and see that this downside correction is coming to an end, you can assume that prices are going to drift back higher. And if history of the past 10 years continues to play out, which that's what technical odds do suggest, then you will see probably a new all-time high set in the year 2012. And if that does not occur, the other alternatives would be seeing sideways and choppy price action during the year. And if you see strong downside price pressure in the first quarter of 2012 to negate the longer-term uptrend line, then you can look back and say, well, we did put in a major market top. But right now, the long-term technicals are still favoring the bullish camp. And the long-term chart is really the most important chart to examine if you're certainly if you're an investor, and even for the shorter term guys, the long-term trend remains up.
So for the new year, Jim, you're obviously more on the bullish camp still.
Yes, indeed.
So, Jim, how do we typically see gold and silver react coming out of the holidays?
Daniela, Importantly, heading into the holidays, you are seeing many commodity traders and many players in general unwinding positions, backing off a little bit, book squaring, and that has had a bearish impact on the commodity markets, including the precious metals. You're seeing volume dry up heading into the holidays. I think when the new year starts, you're going to see some fresh speculative interest come into the commodity markets. There's an old saying that Warren Buffett has that when there's fear in the marketplace, Buffett gets greedy. And when there's greed in the marketplace, Buffett gets fearful. Well, right now there's some fear in the marketplace, and that suggests that the savvy trader could get a little greedy, meaning wanting to get back in and do some buying in these beaten down commodities, including the precious metals.
All right, Jim, looks like it's going to be another fun-filled year then.
You bet it will be, and stay tuned right here, and we'll keep you tuned in.
All right, Jim, well, from all of us here at Kitco News, we wish you and your family a very happy holiday season.
Same to you and to all the Kitco listeners and readers out there.
And thank you for watching this very special holiday edition of Technically Speaking with Jim Wyckoff. We hope you enjoyed it. You can email me your comments and questions, as always, at newsfeedback@kitco.com. For Kitco News, I'm Daniela Cambone.